Hello and welcome to Bloomberg Quint Live and you're watching Trend Spotting. I'm Navneet Saluja D'Souza.
Good morning, Navneet. I'm Agam Vakil, and in the next 30 minutes, we deep dive into specific trends in the markets to draw key takeaways and their implications for investors. But first, the headlines. Wall Street tumbled back into sell-off mode with the Dow plunging more than 1,000 points. Most Asian markets trade with cuts of over 2% in trade. And Indian markets mirror global equities. Both benchmark indices trade with deep cuts. India wicks surges. JSW Steel puts in a bid of 13,000 crores for Bhushan Power. Tata Steel is the only other bidder in the fray. That's a Bloomberg Quint exclusive. And back home, it's an earnings-heavy Friday with 6 nifty companies coming out with their quarterly numbers today.
All right, let's take a look as to what's happening with the markets right now. And as we speak, we're almost at day's low for Nifty. 10,420 is the mark where it's trading. Remember, the opening was a tad bit better than what SGX Nifty was suggesting in the morning, where we saw cuts of over 200 points for SGX Nifty. But the opening was a little bit better, down 150 points. But as the day progresses, we are seeing a bit of more sell-off coming about. So 10,420 on Nifty. But the volatility, that seems to be on the higher side. India VIX has surged sharply in today's trading session after cooling off 8% yesterday. It is back above the mark of 20. Well, the broader markets are outperforming actually the benchmarks today, where you've seen Nifty, Bank Nifty seeing cuts of between 1 to 2%. Bank Nifty is down actually 2%. There has been a good recovery that one has seen for the BSE mid cap and the small cap index, which are right now trading with cuts of only 0.5% to about 1%. In terms of sectoral indices, most of them right now are trading in the red. So you've got the Nifty FMCG, you've got the Nifty Private Banking Index, Pharma, you name it, and all of them are trading in the red. Let's just pull up the metals index, which was bucking the trend when the markets opened because we did see good strength coming from Steel Authority posting good set of numbers. Tata Steel, Nalco, Hindustan Zinc, all of these stocks were trading in the green. But that index has also come off day's high right now. So Nifty Metals Index is just about trading in the green. Let's just pull up the contributors list of Nifty constituents and see which are the stocks that are dragging the index lower in today's trading session. We've seen weakness coming in for the financials, so it is being led by ICICI Bank, HDFC Bank, HDFC. Remember, in the last 3 to 4 sessions, whenever there's been a sell-off, you have seen HDFC twins featuring in that list. They are FI-owned stocks, and we've seen FI selling heavily into the cash segment. Reliance Industries also down, dragging the index by 10 points or so. Tata Steel, Asian Paints, Lupin, Power Grid on the other side are trading in the green. And remember, Tata Steel will be posting its December quarter earnings today, Agam.
That's right, Navneet. And despite the fact that we are not looking at a very encouraging advanced decline ratio, what is heartening to see is that a lot of stocks in the broader markets are still gaining, and they have shrugged off the global weakness. So we are looking at substantial gains in relatively smaller stocks such as Steel Authority of India, which is up as much as 5.5%. You've also seen a substantial amount of strength.
Agam, I'm sorry to interrupt. Today. I think there are some important flashes there on your screen, which is coming from Bloomberg. Fortis Healthcare, Singh brothers are likely to have taken $78 million out of the firm. Just to tell our viewers, yesterday, post-market hours, there was news that the Singh brothers will be stepping down from the board of Fortis, post which we've seen a good reaction coming in for Fortis Healthcare shares in today's session. The shares have been trading in that range of nearly with gains of 10 to 11%. But I guess this news may not augur that well, which says Fortis Healthcare, Singh brothers have likely to taken out $78 million from the company. Let's see how the stock reacts. But definitely the Singh brothers stepping down from the board did augur well for the shareholders, and probably that was the reason we were seeing that positive reaction coming in today's trading session for Fortis Healthcare, the counter which was languishing in the last 5 to 6 months. So we'll keep tracking that news for you. But on Trend Spotting today, well, we decode Quick Heal Technologies December quarter numbers as we connect with this joint MD and CTO Sanjay Kharkar. What is the street expecting from Tata Steel in the December quarter? We ask Mayuresh Joshi of Angel Broking. And we discuss market expectations from key PSU bank earnings today with Asutosh Mishra of Reliance Securities. Well, on to our first trend. Quick Heal Technologies witnessed a 4-fold jump in its December quarter profits on a yearly basis, while the EBITDA jumped over 200% compared to the corresponding quarter last year. What have been the key factors at play for this company? Let's ask the management. Joining us now on the show is the Joint Managing Director and Chief Technology Officer, Mr. Sanjay Katkar. Mr. Katkar, good morning to you and thanks a lot for joining us today on Bloomberg Quint. My first question is if you could take us through the highlights in terms of what's led to a stronger growth that we've seen in both enterprises and government sectors.
Yeah, so as we have been focusing more on enterprise and government sector since last couple of years, in fact, I'll say. And the reason behind the traction is that we have scaled up our products to handle larger networks. So our target or maybe addressable market has grown. At the same time, we have also increased our system integrator network, which has resulted into a better traction on the government and enterprise front in this quarter.
And what's behind the slackness in the retail segment, sir? Because with the growth in PCs and laptops slowing, what areas are you looking to find growth in, and what are the new growth avenues there?
Yeah, the PC, even though it is showing a slightly decline, but it is over the 9-month period. If you see the quarter results, they have shown increase of 7%. So we do see that the retail segment will grow in single digit, but there will be growth because it's like the reason that we are seeing the slight decline in the 9-month result is we had seen a very low first quarter because of the GST rollout, and now that's behind us, and now we are focusing on increasing the retail sales. So our focus will be on increasing the market share, at the same time trying to see newer avenues like smartphone security and further down the retail products like router security and all that. So that's yet to release the newer products, but that is something we feel that will definitely give us better traction on retail front as well.
Sir, what do you attribute the margin expansion this time around that we've seen? And also tell us, are these margins that you've posted in the December quarter, are they sustainable going ahead?
Yeah, the margins are sustained in the sense we being a product company, we are our expenses are fixed, and whatever leverage we get is out of the sales that we get extra, over the product sales and licenses that we sell more. So margins, I don't think there will be much pressure here. It will be sustained, and there will be little more improvement in quarter 4. I do believe that actually.
And how is Quick Heal adapting to the change in trends in gadget security right now, and what is Quick Heal doing about it?
Yeah, the changing trend in the sense more and more threats are now targeting mobile and smartphones, especially after this cashless economy being promoted more and more transactions are happening through smartphones, and so newer threats are targeting the apps that are payment apps and wallets on smartphones, and so we do feel that this is something, this trend is going to grow. So security for smartphone is something that will really get more attention, and that's what we are also focusing on, creating more awareness. Our products are ready for smartphones, and this should definitely help us in the coming quarters, I'll say.
All right, sir, thanks a lot for joining us today and taking us through your quarterly earnings. Let's move ahead and talk about the sugar space, which has been in focus. Remember, there was a news that government is fixing sugar release quota from mills in order to arrest the price fall that one has seen in the recent past for the sugar prices. Let's get a better view, actually, whether this has taken place or not. We're joined by M. Manikam, MD of Shakti Sugar. Hi, sir. Good morning, and appreciate you joining us today on Bloomberg Quint. Could you confirm the news for us that the government has fixed the sugar release quota from the mills in order to arrest the price fall?
Yeah, they have. They have, I think it's an attempt to stabilize the prices. The government has issued the orders for that. And we hope the prices will stabilize.
What sort of price fall, sir, that we've seen in sugar prices in the last 1 month or so?
Almost about 3 rupees per kilo. We've seen a drop.
And do you see that 3 rupees being recovered with this quota?
Possibly not, because the main thing that the government has to do is make sure that the states don't announce higher prices. I think particularly now Uttar Pradesh is announcing a much higher price than the FRP. So there's an incentive for the farmers to grow more than what is required. So I think they should allow the market forces to play, and which means some of the states should be, requested not to go ahead and announce these prices. So that is the only thing which is a long-term solution.
All right, so Mr. Manikam, how are you expecting sugar prices to develop from here onwards? And what is the inventory that you hold, and what implications can it have on your inventory?
See, we don't have too much of inventory. Most of the Tamil Nadu mills, we are going through a very bad drought. So the production in Tamil Nadu is down to 20% of our peak production. So we don't have a major issue at this point of time. But it's the mills in Uttar Pradesh and Maharashtra who would be facing a more difficult situation because their production has really gone very high.
This has come into effect from yesterday?
Yes.
Okay, and what sort of quota limit is there? If you could just give us more details.
No, they've said roughly you can sell about 17% of production in February, which is, fairly low if you look at the total thing. So that should stabilize the prices. But we'll have to see how much is what they're going to, see in the market, because we might be doing, I think we need about 20 lakhs per month. And the quota may be just about the 20-25 lakhs. So we'll have to see how the prices really pan out.
So will this move make the mill owners, the payment to sugarcane farmers, will that become smoother now?
It will probably get more delayed because, see, most of the millers were selling the sugar and paying the farmers. Now you're restricted to sell the sugar, so you won't be able to monetize the sugar, so you will not have cash. So this move probably will, delay the payment to the farmers.
So could you tell us the time frame? How much delay can it be?
It depends upon how much the government is holding on to this. So possibly we could look at a delay of about 60 to 90 days as it goes forward.
60 to 90 days. And if I'm not mistaken, sir, this move has come after the government has also doubled the import duty on sugar imports to about 100%.
Right. Import duty really doesn't have a relevance because there's no imports coming in at this point of time. So even at 50%, there was no imports coming in. So today, imported sugar coming into India is not really a major threat that we have at this point.
Why such a move of doubling the import duty if there were no imports?
I don't know. I don't know.
Okay, sir, I think we'll leave it at that. No, thanks a lot for joining us today and giving us that clarification. He's actually confirmed that news that the government has actually put a quota on sugar mill owners in order to release the sugar. So, as he mentioned, Agam, that 17% of the production is what they can sell in the month of February. Well, let's just do a check of the entire sugar space and see how it's trading, because I remember yesterday and day before yesterday, there was some traction that was seen in the sugar companies. Balrampur Chini trades with gains of 0.7%. Mavana Sugar is actually up and about with gains of nearly 6%.
Absolutely. Well, a lot of sugar stocks have picked up to a certain extent, but we'll keep addressing and we'll keep coming back to the sugar story. Let's go and take a look at some of the big earnings that are going to come in today's day of trade, and perhaps some of them post-market as well. The first one will, of course, be Tata Steel, because rising steel prices and higher production in India is expected to aid Tata Steel in the third quarter. The country's second largest steel maker is expected to post a multifold rise in its bottom line. What else is the street expecting? Well, let's get an expert view here. So we have Mayuresh Joshi, fund manager at Angel Breaking, joining us on the show. Mayuresh, thanks for joining us. Let's just start off with your expectations for Tata Steel. What it looks like, it could be a quarter in which we could see some substantial improvement.
Morning, Argam. Yes, absolutely. I think the domestic operations should be very, very strong for Tata Steel, specifically considering the ramp up in its Kalinganagar operations. So the volume growth that one really expects is to come anywhere between 3.2 to 3.3 MT. And what really happens is even the realization growth can be pretty strong. So I think what they realized last quarter on an EBITDA per ton base of 11,000 odd rupees, that can show a substantial jump. Obviously, again, I think the rise in input costs, both iron ore and coking coal, is something that will abet the growth both in realizations and the EBITDA per ton on the domestic operations. When it comes to the European operations, I think it's a traditional weak quarter. Add to that, I think the rise in coking coal prices is probably going to take sheen off in terms of the EBITDA per ton reported. So I think it should be around the same mark or a little bit lesser at around $40–41 per ton. But a large element in terms of their Southeast Asian operations should do well, because the rebar to scrap prices have actually stabilized, and that again with lower steel availability, specifically in terms of Chinese exports, should abet prices. So yes, I think strong volume growth for domestic operations offsetted by a weak seasonal quarter in the European operations. But again, I think strong EBITDA numbers from the Southeast Asian operations with ferrochrome prices holding up should probably aid the overall earnings for Tata Steel.
Mayuresh, I want to talk about the domestic operations. What are the expectations? Because we've seen the numbers improving from the domestic operations of Tata Steel. On a standalone basis, what sort of EBITDA per ton and realizations do you expect? And keeping in mind that input cost pressure persists for the entire sector in the December quarter for the steel makers.
So morning, Navneet. Again, I think on a quarter-on-quarter basis, you're probably going to see volumes, as I said, around 3.2, 3.3, because the Kalinganagar plant is ramping up almost to full capacity. Add to that, I think the cost optimization efforts, and because the entire ramp-up is probably going to be seen in utilization levels going up, that natural leverage can be seen on the balance sheet. As I mentioned again, I think input costs probably are going to have a say in terms of overall realizations. But I think the partial pass-through that has probably happened is going to abet Tata Steel. So I think the EBITDA per ton that they reported specifically on domestic operations at 11,000 odd rupees a ton, I think that should show a substantial improvement, anywhere between 1,000 to 1,200 odd rupees. So anywhere between 12 to 12,200 odd rupees on an EBITDA per ton basis on the domestic operations is something that we are probably working out on.
Okay, Mayuresh, so let's shift focus to the oil and gas space now, and we also have ONGC coming up with earnings. Based on the kind of earnings that you've seen for Reliance Industries, what can we expect for ONGC?
So Arkham, again, I think if you see the change in crude prices on a quarter-on-quarter basis, it's a 19% jump. So the average Brent realization has been close to $61.4 a barrel. Now the gross and the net realization stays absolutely similar for ONGC. So in that sense, I think a very strong earnings growth is something that one can really expect from ONGC, both in terms of the top line that is reported on the EBITDA front, which again is a pass-through in terms of a strong growth on the bottom line. In terms of oil production volumes itself, I think strong number is expected, because from April to December, they've produced almost 15.5 MMT. And again, I think the overall annual production numbers that the company had given out, and even for the next fiscal, is anywhere between 24–25 MMT. The gas production is also expected to increase substantially. And the oil production, again, I think will strongly get abetted with larger volumes coming through, both from Vasai, the Ratna series, the R series. And again, I think as oil prices stay in this range, I think that pass-through effect is going to be entirely felt on the earnings. Dividend yield is strong. So I think strong earnings are expected from ONGC, but I think the entire value play is going to be how crude oil prices pan out from here over the next 1 to 2 quarters.
Mayuresh, with regard to ONGC, I remember 2 days back there was an exclusive story done by Bloomberg saying that ONGC may sell stake in GAIL and IOC in order to, buy that stake in HPCL. Obviously, we will be watching out for some commentary on that front as well when the numbers come out. But what is the likelihood that they would actually go ahead and sell stake in these companies in order to buy stake in HPCL?
So there are two aspects to this, Navneet. Again, I think they already have sufficient credit lines in terms of funding this exposure, and in case they want to probably take off the investments, I think it probably understands and assists that the cash flows will still remain extremely strong. Now, in a scenario that they go in for a market borrowing program, I think that amount of debt on their balance sheet probably increases. But again, I think the strategic investments that they've probably done, and these are strategic in terms of each of these large PSUs holding cross investments with each other. I think it will be very, very interesting to see if they do go ahead with this plan. I think in what manner are they going to offload it, whether it's going to be in one tranche, two tranches, But overall, I think, as I said, I think a mix of both, or even if they take debt on a standalone basis to fund the HPCL acquisition, I do not foresee huge changes happening in cash flows for ONGC. But yes, I think it does put a little bit of an additional stress, because I think the debt levels probably go up. And to that bit, again, I think you're probably going to see the earnings estimates probably getting offsetted with the kind of moves that the crude prices can probably give on their bottom line.
And again, Mayuresh, we've seen earnings from IOC, but, a lot of analysts out there are of the opinion that you cannot draw the same conclusions with expectations for HPCL and BPCL with IOC. Are you also of the same opinion, and what are your expectations then?
So for the downstream or the OMC pack, what has really panned out is that the marketing margins have shown a sharp decline. So what you saw in terms of marketing margins getting reported between 3.2 rupees per litre, they have clearly come down to around 1.7, 1.8 rupees a litre. So the sensitivity to earnings in terms of marketing margins obviously goes down. On the other hand, I think the strong GRMs, because Singapore GRMs were $7.3 a barrel for this quarter. So strong GRMs are expected to be reported. Inventory gains are expected to be reported. But again, I think, as I said, they get offsetted because of lower marketing margins. So how do these OMCs get placed? Again, I think if crude stays in that range between 65 and 70, there is no substantial under-recoveries or subsidy sharing that OMCs will need to bear. And in that sense, again, I think the earnings trigger becomes more or less in terms of new refining capacities which are coming through, and the cash flows that one really can expect, because the new capacities which are on stream at this point of time have very good complexities. So again, I think GRMs over a longer period should hold up. Marketing margins, again, I think should probably start stabilizing around these levels, unless you see substantial cuts happening on the excise duty front if crude jumps up, and that creates a spanner in terms of the earnings outlook. But overall, yes, I think if one really has to do certain assumptions, the throughput should be quite reasonable on a quarter-on-quarter basis. The GRMs, as I said, should be quite strong because of the inventory gains and the movement of crude that we've probably seen on a quarter-on-quarter basis. The longer-term outlook obviously depends on all these factors, but within this pack, I think IOC, in my opinion, is still better placed compared to the other two.
Mayuresh, so among the oil marketing companies, you're suggesting you like IOC, but overall in the oil and gas pack, which is the top pick?
So as I said, I think downstream it's IOC. Upstream, again, I think Reliance, because of the integrated nature of its operations, is something that we'll continue to like, with the caveat that the large part of the capex on its core operations is done. The telecom capex should be in a sustained and a constrained manner going forward, which should abet its return ratios. For the midstream companies, again, GAIL is something that we'll continue to prefer, more in terms of the revision of tariff gas pipelines that can actually happen for GAIL, and the expectations that the petchem business, both in terms of volumes as well as reported EBITDA, should show a significant amount of traction, along with good growth happening from the LPG side of the business as well. So I think midstream GAIL, downstream IOC, upstream Reliance.
Okay, Mayuresh, we leave it at that. Thanks for joining us and giving us your expectations for the big earnings of today. We'll be watching out for several of those factors that Mayuresh has brought forward for us, and what implications that may have for the stocks moving in. But we will move on to the other important story of today, and that is Fortis. Malvinder and Shivinder Singh are set to have withdrawn more than $78 million from Fortis Healthcare. This has also prompted the auditor, Deloitte, to refuse to sign the quarterly earnings. Bloomberg News' Ari Alsterdare, beg your pardon if I have mispronounced the name, joins us now with all the details. Ari, can you tell us about the further developments with respect to this aspect?
Right. Hello. So what's happened is it seems that the Singhs are working to repay the money they took, so that the quarterly results of Fortis, both the second and third quarter, can be reported on Tuesday. That's February 13th. So that seems to be the state of play right now. So it seems that they're trying to return the money and are on track to report. In a statement to us, they claim that this money was not routed to the Singhs originally, but that in fact it was loaned to other parties who have only since become part of the Singhs promoter group. And since that happened in the third quarter or so, they have declared the loans which are already outstanding as related party transactions. But that, of course, is not what our reporting tells us. That may have been what they've done since, but that is not what our reporting shows is the whole story.
Harry, just a question there. I think the story which is done by you also says that now the Singh brothers are working to repay that amount. Any sort of idea how they're looking to pay back? Will they be selling their stake in Fortis Healthcare?
You know what? It's hard to say exactly how they're going to do that at this point. We couldn't get that granular information. What we do know is they are working on it, pursuing whatever avenues are available to them. Because you know, as has been reported, the group, the Singh group of companies, is facing a pretty dire debt situation of its own. There has been a default already at the group company level, and that has in fact been what's prompted the discussion of asset sales over the last year. So how they are going to repay the money, I can't say, but we do know they're trying to.
And the reason for not publishing the second quarter earnings was this, Ari, because Deloitte did not approve it?
That's right. We've heard that's what prompted that decision to delay. They needed to sort out this issue with the balance sheet before they could release the results.
Okay, Ari, we'll leave it at that. Thanks for joining us and giving us these updates. We'll keep giving you more developments with respect to this story. Of course, Fortis Healthcare right now is currently trading very well in the green. In fact, up as much as nearly 11%, currently trading at around the mark of 140. So this news has been taken with both hands when it comes to investors, and certainly positive. It's considered to be positive news on as the Singh brothers step down from their positions.
But this could be another blow, actually, because this was not known in the market till now until Ari broke this news. And let's see if they're unable to repay the amount. I'm sure it's not going to augur well for the shareholders as well. And you know what this says, what Ari's story puts out is that the loans were recognized as related party transactions. And that was the reason why Deloitte delayed certifying the quarterly results as well. And probably now they'll be looking to repay. But how do they repay the amount? Because they have to pay Daiichi as well for settlement.
Comes down to around 500 crores, if I'm not mistaken. That's not a small sum.
Not at all. And besides that, they have to pay Daiichi now because they lost the case.
That's right. That's another 3,500 crores. So yeah. Yes, some worries coming in for the Singh brothers. But continuing with earnings, to the big PSU banks, State Bank of India and Bank of Baroda will be reporting their December quarter earnings today. What is the street expecting? Well, let's get in Asutosh Mishra, lead analyst at the institutional equity for banking and NBFC at Reliance Securities. Thanks for joining us. Again, let me start off with SBI first. What is your expectation and what are the factors that you're keeping an eye on when it comes to the earnings for this quarter?
Yeah, so we are expecting a profit of 1,145 crores in this quarter. And sequentially, this profit will be declining because in the second quarter there was a one-off income of SBI life insurance in the last quarter. So that will be not there. Over and above, there are a few more negative. Impact during the quarter. One is lower treasury profit. Yields has gone up. Higher mark-to-market provision on the HTM portfolio, along with the accelerated provisioning on the NCLT deferred as well as stressed portfolio. So we continue to see that overall profitability will remain weak for the SBI in this quarter. Yes, on operating front, they will see some improvement. Like we are expecting sequential growth in the NIMs as well as NI. NIMs probably because this will be the first quarter where the full impact of saving rate reductions will be get reflected. And they're also winding down some of their international operations, which was relatively low earning assets for them. So that will give good flip to the net interest income growth. Secondly, on the core fee income also, we are expecting a good growth on sequential basis. Number are not comparable for SBI on year-on-year basis because of the merger. So we are expecting a good growth on core fee income on sequential basis also, led by the retail banking fee. So overall, we are expecting sequential improvement in the business, but overall profitability will remain under the pressure because of higher provision for the mark-to-market loss and higher provision for the non-performing assets.
Asutosh, quickly, we're running out of time. If you could tell us what's the expectation from Bank of Baroda?
So Bank of Baroda, we are expecting a profit of 206 crores and slippages of around 3,200 crore rupees. Last quarter it was 3,400 crore of the slippages. So we are expecting sequential decline in slippages for Bank of Baroda in this quarter. And again here loan growth is expected to be around 14-15% year-on-year basis and 2% approx quarter-on-quarter basis. Key monitorable for the Bank of Baroda will be how really they are progressing on the transforming bank from the corporate focus towards the retail focus. That will be the key things to watch. And what is the Parivartan, the project Parivartan which they are running, how really that is spanning out for the bank.
Okay, Asutosh, we'll leave it at that. Thanks for joining us and giving us your expectations for SBI as well as Bank of Baroda. As far as the Fortis story is concerned, you can also read the complete story on the Singh brothers on BloombergQuint.com. But with that, it's a wrap on this edition of of Trendspotting. Up next is Hot Money, so don't go anywhere and keep watching Bloomberg Quint.
Nine to 5 job, अरे 5 to 9 job, भाग दौड़ all the time job.